Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for Tuesday, April 14th, 2020. What we'll do in this video is take a look at trend indicators. Some of these I've shared recently, and some of these I haven't shared in quite a while. So we're not going to look at a ton. We're not going to go through every single index on really I think we'll stick with the SPY, the S&P 500 here, because that is a broad market. You're going to see similar trend indicators on everything else. Nasdaq 100, some of its longest term trend indicators are still holding up because again, that's not as diversified. It's not representative of the entire economy. It's really mostly representative of the technology sector. So when we look at the S&P 500, we're looking at 500 different companies instead of 100, and we're looking at them over 11 different sectors that pretty much give us pretty good representation of the overall stock market and economy. So we'll start out here. This one I have shared recently. It's we'll just look at it quickly. It's a monthly chart, long-term chart. So every candlestick is a month. 1 month of trading action goes all the way back into the early 90s, and the two things that stand out on this particular chart are the 20-month exponential moving average. Does a great job of defining bull and bear trends. This is the dashed blue line I'm highlighting here. When you're above it, you're in a bull market, and when you're below it, you're in a bear market. Simple as that. So you're looking at, since that span back in the early 90s, we're going back many decades, but we've had over that period of time 3 bull markets and 4 bear, three bear markets and 4 bull markets. Let me try to give you a box it in here. So you had a great bull market back here in the 90s leading up to the dot-com bubble, followed by a bear market right there, 51% bear market. That in turn from the 2002 lows up until the 2007 highs was bull market there, followed by a 57% bear market roughly, and you had a close near bear right here. We had a divergent high, and we flirted with that 20-month exponential moving average, and most recently we broke below it. So that is the single most technically significant event on this chart, is that last month we closed solidly down below it. And you can see, usually sometimes when we have these corrections, you flirt with it and you get these stick saves. Either we close back above it at the end of the month, because that's all that matters, a monthly closing candle, or if we do close below it, it's marginally below it, and then you recover it the next month. So where we're at right now, here we'll zoom in a little closer. I just want to again point out the those longer term sell signals that would have got you out of the last bull market, out of your longs and into shorts pretty early on in the bear market, and then same thing, got you back in when the 20-month was recovered right there. And again, here and here, sell signal, back test and a failure at the 20-month, recovery of the 20-month there. Throughout most of the bull we've traded above it, and then again we had a one candlestick close down there in December of 18. We snapped back above it and closed back above it and held above it since then. There we are. Last month's candle solidly closed down below. We closed there at 257 down here at the fat part of the body where my crosshairs are, and right now, so I'm doing the video, we're close to back testing that from below. So it's maybe similar to what happened in 2008 in the last bear market when we went below, and right here, and we zoom in for you, if I can grab this. Ooh, little too much over zooming there. Right here, this is December. This is the top in October of 2007. Broke below it, closed that month right there, the month of January. We had a confirmed sell signal. Stayed below it all throughout the month of February, all throughout the month of March, all throughout the month of April. Back tested. We had a back test and a failure there in April. And then in May, attempted to recover it and failed to do so on a closing basis. So you can see we closed the month back down below it. So that was another successful test from below. And then the following month in June there, that was May's candle right there. And then June, we tried again. We tested and then closed the month solidly below. And that's when the market gave up the ghost. After 1, 2, 3 months, or not 3 full months, that was the end of the month there, beginning of trying to regain that level after we'd clearly taken it out. So the million-dollar question, and only time will tell, is that what this is, a back test, or is it more like December of 2008 where we closed below, but then we went on to regain it the next month? So it was just what we call a whipsaw signal. Time will tell, but I wanted to share that. And then more importantly, what's a little different too this time is we've also solidly taken out the bull market uptrend lines both the yellow primary, that's the primary trend line I had. It was broken back in 2018 and pretty much back tested since then with a rejection there. And then this secondary benefit of the doubt trend line comes off the 2009 lows there. So as far as trend indicators go, we had also divergent highs right here. Divergent high back in 2018, the fourth quarter, that was the catalyst for that big 20% or so, roughly almost 20% drop in the S&P, and then the bigger drop so far. Again, as I talked about, the divergences back here were only extended and grown much larger when this drop started here. And you can see the preceding bear markets right here, the 2007 to 2009 bear markets, similar technicals, divergent high, trend line break, divergent high, trend line break. And so again, we're going to focus on trend indicators. I often talk about price levels, support lines, trend line support, and resistance levels, and other things like that, Fibonacci's, but here we'll stick to the trends. All right, one other trend indicator that I have we'll look at, and that would be this, what I call my quad trend indicator. It's the one saved a layout here with 1, 2, 3, 4 different trend indicators, starting with the longest term, this monthly chart right here, and that shows you a couple different. Remember, we were just on a monthly, but we were using the that 20 month as a single trend indicator. Here we can go to this one where we have a 10 and a 6 period exponential moving average, 2 lines there, in orange and blue, and when they cross, and that's what you can see down here. If you can't make out where the crosses occur, I'll put the crosshairs there. You can see this histogram. If this histogram goes from green to red, it means that that faster moving average, the 6 EMA, has crossed down below the slower moving average, which is the 10. That was a little whipsaw there. And now what you're looking at is the black line here, black dash line. That's the S&P 500. So you got a sell signal. It was a little bit of a whipsaw, but the market did go into a multi-year trading range and a near bear market back then. So it wasn't really a whipsaw. It would have got you out. Even though it got you back in the middle and got you out again, that was a period of making no money in the market. You could have made some money, swing trading it, but as for a trend trader, longer term investor, nothing there. When you roll back in time, that's what I should have done here to begin with. You can see when you look down below, again, you're not going to make out on the video that well the lines crossing, but that's why I did the histogram here. So basically, this 10-6 custom histogram shows me when the 6 EMA is above the 10, because the histogram is green. It said bull trend. This is 401k, IRA, long-term investor stuff, not active trader stuff. And then did a phenomenal job. It didn't get you out. It's a slower moving indicator because it's based on a monthly chart. So it didn't get you out at the very top, but darn close to it. You can see right here. Here, pull up, and it told you this point. I didn't do that right. I got to grab right here and pull that all the way up to the top like this. So to show you here to here and over, it said bear market, be out of your longs or be short. And then here it said bull market from, as you can see right here when we crossed over, all the way to this point in time. And it captured, you can see here clearly, it's captured the bulk of almost every bull and bear market that we've seen in the past several decades. And you can go back as long as you want really using this. You'll probably see the same thing. And a few whipsaws, nothing's perfect. I use various trend indicators, and that's why I don't stop the video here and say this is all you need in trading. This kind of helps you paint the bigger picture where we're at. We have had a few whipsaws, I will say that, in recent years. We'll zoom in a little tighter. But we can see right now both the ROC 13 is one of my confirming indicators right here. Last month we fired a solid sell signal on that. Remember, monthly chart. So right now it's showing that we crossed right back above there on the ROC 13, but all that matters is how we close this month. And we have rallied back into resistance. So if we get rejected here off the resistance, we're so close. We're going to have a second confirming close down below the zero line on the ROC. That's the rate of change 13, and sometimes I'll toggle that to ROC 12, and you can see, and that's actually what I started out with way back when, using an ROC 12, and that one's still on a sell signal, as is that 10-6 pair. You can see it's still below the zero line on the histogram, meaning that the 6 EMA is still trading down below, and if you zoom in real tight you can see it there. So that shows you those crossovers. So there it is. That's all my longest term trend indicators right now are saying the market is on a sell signal, and make of it what you will after today's rally. This can and will change, and again, because it's a slower indicator, if you get whipsawed, and you hold off until you see all these long-term indicators flip back to bullish, you will lose money on your shorts. You will have lost out some on your longs, but that's why we're going to, as we drill down here in just a second, we're going to get to the shorter-term trend indicators. All right, that's monthly. Let's take that back down. And now we go down here to a weekly chart. Oh, wrong box. This is the one I need right there. Okay, and so what we have on the weekly chart is similar thing, but we're using let me shrink this box down where you guys can see it better a little bit here. Let's grab right here, go down and in, just so we don't cut anything off. All right, so we're looking at a little bit faster indicator using a 17 exponential moving average and a 43. Remember, again, on a weekly chart. You don't put these on a daily chart, they're going to give you a different story here. This is a weekly chart, and down on the bottom, I'm going to scroll back. You can see the same thing. Pretty clean and simple. This is not very, tricky stuff here. You had a bull market that was that great bull in the 90s, and it told you throughout that be long and strong. Here told you throughout most of that. See, since it's a faster indicator, it's going to get you short out of your longs or into shorts a little quicker. So that whole period it said bear market, be out of your longs or be short. If you were so inclined, and here it got you in the bull market right there and told you bull market, stay long with zero whipsaws. By the way, you can note that here, without any whipsaws, a near perfect indicator up to that point. Then told you bear market from here to here, and that was the great bear right there, the great recession back in 2007 to 2009. Again, did it get you in at the bottom or out of your shorts? No, but that's where we're going down to these shorter term indicators. They're faster moving, they're going to trigger quicker. Now you had a couple whipsaws. You may call them whipsaws, but you can also say that, hey, there was a sell signal to be made. You probably, by the time this longer term trend indicator triggered, the bulk of the move may have been over. So even if you took it, even if you took this religiously, at worst case you got whipsawed out, and again you captured the bulk of every trend, or the bulk of the entire bull market, I should say, even if you factor in those whipsaws. Remember, 2015 to 2016 was a near bear. In fact, the small caps, mid caps, and many sectors did have a bear market, a drop of over 20%. So I wouldn't call that a complete whipsaw signal. It was a good time for long-term investors to be out of the market to avoid those drawdowns there. And again, we did have in 2017 or 2018, late 2018, we did get a whipsaw there. By the time it triggered on this one, it was probably too late. But again, you can see something here that I know. I'll show you what I see when I look at this. I see these. Again, call them whipsaws if you want. They did get you out of at least part of the drop there, but they were relatively small. What happens right now, or what's happening right now, is this indicator, the 17 and 14. The 17 is so far below the 43 that the histogram's all the way down here. The only other time in decades that it's gotten this low was during bear markets, was right here and right here. So just food for thought. By that account, maybe that's telling us that this is just early stage bear market action, and you get those counter trend rallies. The indicator will come back a little, the moving average pair, but they failed to ever cross over and give you one false buy signal during those last bear markets. They worked 100% effective. And then walking down in time, remember we go down these now we're at a daily time frame, so a little bit faster moving averages here. We have a 20 and a 50 on the chart here, the green and red lines, and I also put those in histogram form to make it easy to see when they've crossed. And again, this is going to be give you quicker signals in and out, but the downside to the faster signals are whipsaws. Again, you can see here, let's say right there it went red and pretty much got you short or out of your longs most of that time. Gave you another sell signal there. Quite a few along the way. Here's some of the bigger ones right there. Got you, let you sidestep that from your longs, or told you the trend was bearish. And you can see now nothing close. This is This is, again, you roll back. I can't go back much farther. We're looking at a daily chart, so I'm going back about to 2014. That's all it'll give me here. But I do have this one on another charting program. I can go back farther. So that's it. Actually, one more on this quad trend. Finally, this is the some shorter term stuff. 20-month, 20 exponential moving average. When the S&P is above it, the trend is bullish, and when it's pointing up, so we'll give it this. So there's some check marks now for the shortest term trends. Here are some other trend indicators. You don't see the EMAs up here. I just put them in histogram form. 39 and 13, again, daily chart, so these are daily EMAs, and a 26 and 13, and they also do a pretty good job of telling you what the trend is. In other words, right here it said bearish trend all that point. Everything else on there other than these are bullish trends, and so right now the trend remains bearish at this point in time in the S&P. So of my short-term trend indicators, we have a couple that have flipped back to bullish recently, with a couple still on, and everything else out. Everything intermediate to longer term still bearish as of right now on the S&P 500. Here's the 20 and 50. And what I can do for members of the site, I'll post these the links to these charts, my actual charts. If you use stockcharts.com, you can save them. You can still view them if you click the link, but I believe if you don't have a Stock Charts membership, I'm not sure if they're going to let you save a daily chart that goes back more than a couple of years. That's the difference. They give you free charts on stockcharts.com, but they're going to limit the amount of time you can go back. So either way, you can at least view that by opening the link, but I think when you go to refresh it or make any changes, of course you have to have an account to save it anyways. But this is the I already covered this one. I'm just showing it on a different board here, different charting program. The 20 and 50 EMA pair, very common, popular pair to trade, and you can see the same story. What I did, it's kind of busy on this chart, but the red lines show a crossover. I also created a custom histogram on stockcharts.com. You can see how I did it. I just use a MACD, and what you do, just plug in whatever moving average pairs you're using. Could be the 1743 on the weekly like I covered before, and then just put the 17 there and the MACD value, put the 50, or in that case the 43. Here I use the 20 and 50, of course, and then change that last number to a 0, and what that'll do is do exactly what I did on. I had to do it a different way on TC2000. It took me a while to figure that out, but it'll give you the same thing. It'll show you when these lines cross in histogram form, when they cross below or above the 0 line. And you can see nothing's perfect. There's a few X's in there. Those are whipsaw signals, but for the most part, because it's a faster trend indicator, it gets you in and out. And you can see this was the last bear market in 2008, so it got you in pretty darn early near the top, kept you short almost the entire time. We had a counter trend rally. It did give you a buy signal and actually let you catch a good part of that counter trend rally, and then told you to get back short again and to stay short all the way into the bottom, and not, you gave back a little off the lows, because again, it's a daily trend indicator. We'd be using other things really to exit there, such as divergences and trend line breaks, price resistance, maybe a selling climax, a bullish engulfing candle, or a lot of other tools and technical analysis that we use in conjunction with these trend indicators. So it is possible to even get in quicker, closer at the top, and get out closer to the bottom, but these again are maybe for the less active trader, or to kind of just confirm, because that's why I'm doing this video now. A day like today, especially after the last few weeks like we just had, will make anybody second guess their convictions on whether or not the market's going low or not. And look, these trend indicators, each and every one, you'll find there are whipsaws, especially if you go back far enough. But what they do is, if you can see a pretty reliable trend indicator, and you can see that we're still on, like for example, even on this one, most of these trend indicators are still bearish. We had to cross right here. It was bullish all throughout here. It gave you a buy signal back in early 2019, right after the lows, and remember that big drop in the fourth quarter of 2018, and this trend indicator has stayed bullish other than a very few very minor and brief whipsaw signals. So it does a really good job of capturing those, and where I'm going with this is it's clearly in bearish territory right now, telling me that by nearly all accounts right now the trend is still bearish, the longer term trends, and therefore one should be viewing rallies back to resistance levels, to Fibonacci levels, to moving averages as opportunities to exit longs if you didn't get out on the first drop, and or add short exposure. And if this all starts to change and we continue to go up and key moving averages are taken out and short term after short term trend indicator flips to bullish, and then the intermediate trend indicators start to flip to bearish, then we might be looking at something different. We might be looking at another situation like back in the fall of 2018. But as of now, by all accounts, or just about every account that I'm looking at here, we're not. Okay, I could go through these. These are just the same ones that I covered in the beginning of the video on stock charts. Some of these, like the 1743 on the weekly, and again, you can see it here. But the nice thing about it is stock charts will allow me to share these charts by clicking on this. Give you guys a link to those charts so you can save them as your own. And but there are a few others that I haven't covered in a long time. Let's look at those real quick. So we're on trend indicators, and let me pause this and pull up the ones I want to show you. Actually, take that back. No, we're done. I have a ton of trend indicators. I can talk about them all day long. We can look at different indexes, and I do share different ones different times. But let's flip over and just give you 3 more, but we'll give you breadth indicators. It's different. Trend indicator obviously is going to show you the current trend, and then breadth indicators will show you. It's like looking under the hood. It's like your car. Your car may be moving along right on the road, but something sounds a little funky. Maybe your car is not accelerating as fast as normal, or you hear a little noise. Your mechanic lifts the hood and finds out what's wrong under there. Maybe there's a loose spark plug wire. Maybe there's a oil leak or something. And that's what breadth indicators do. So you look at the market when it's rallying, and in a strong market, you should have positive breadth. Most stocks moving up, but then when the market continues to advance and you start to all of a sudden see deterioration in market breadth, that's typically a sign of bad things to come or a trend reversal. And there were red flags, and I've covered these for the last year or so. We had divergences in breadth, just like we had divergences, the same divergences I covered on momentum indicators, like negative divergence on the MACD and RSI and PPO on the daily and weekly charts that led up to this big drop. We had multi-week or multi-month and multi-year divergences across the board on a lot of stocks, particularly in the Nasdaq, a lot of tech stocks and all that. But we're not going to get into all those divergences. You can see some on this chart. What we're looking at here is the NAHLR. That's the Nasdaq new high to new low ratio. So that just shows you right up here, up top, the ratio of stocks making new lows and new highs. And I guess I put that in log scaling. I should flip it over. What you would see is, these are the ratio numbers, because it's in log, it's kind of compressed, but it shows better on the chart. Now, forget about the numbers. To me, that's insignificant. What I look at on when I study this chart, and I created this one a while back, I looked at what jumped out to me is there's a certain level, and it's a pretty distinct and clear level. It's right here. It doesn't matter what that number is. The value is not even populating on here. If I held the crosshair, I can give you that. I guess some people might ask, so what is that value? 0.01. But either way, that's irrelevant. You can see that when this indicator drops to that point, and we're going back here all the way into the last bull market, or right around right when the last bull market ended. There's 1999, and so we're going into the 90s there, and the last bull market peaked. Not the last bull market. That was the dot-com bubble. That bull market that ended in 2000, all the way up, strong bull run into the 90s. Okay, so what happened from there? Well, since that point in time, that's over 2 decades ago, we've had just a handful of drops down to this level right here, that blue line. Okay, and so most of the time, those have proved to be great buying opportunities, right? You can see it here. Let's go back in time. December, excuse me, family dog freaking out. All right, we had a major buy signal right there. We hit it in late December of 2018, and that marked a significant bottom. There was a big rally that followed. We had a major buy signal. Again, we'll just say, I won't call it a major buy signal. I'm just going to say a buy signal triggered. You can see the dotted lines right there. You probably can't make it out on here, probably color coded. I have green lines here for the buy signals. That's where the dash line just goes down and shows me where it hits. So buy, 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 near, very close, we'll call it close enough buy signal. And that was a big bear market rally right there in the Nasdaq Composite down below, but it came before the bottom, so we didn't really fully hit it there. But every other time we hit it, you can see we had some pretty good buy signals. There was that first bear market rally back in 2008. Now, where I'm going with this is, okay, so in a bull market, you buy hand over fist. And if you believe this is a bull market going to new highs, you probably just had your best buy signal in over a year right there, right? And the time before that was all the way back in 2016. You would have caught all this. And you bought again here, you bought a ball, got all that. Now, however, things change, and this is where people, this is why bear markets really destroy people that don't recognize it for what it is. And this, it may be, maybe this isn't a bear market, but if it is, what happens is people that continue to buy on these indicators don't recognize if there's enough evidence supporting the fact that the bull has ended, and they're treating all these buy signals, they're treating other trend indicators and other buy signals they use that work great in a bull market as such. What happens is they get burned. So here you went ahead and you bought. Let's just look what happened. And all we're doing is going back to the last bear market here, guys, back in 2008. So you bought there. You can see right there. Yeah, you did catch a good part of a bear market rally. Now that, again, that's probably over right now. We've had a bear market rally. I'm going over the assumption that it is over or close to over. So that's it. And then what happened the next time you bought it here, you got clobbered. You got in, and if you held on, you lost. You were long throughout the bulk of the drop in that last bear market. So what I'm trying to say is this thing fired, and it kept firing and firing and firing. It went well below there. When it looked like the worst was over after it snapped back, it fired again and kept firing and firing and firing. So this is bear market stuff. And so we'll know that soon. If we reverse here and we take another run down at this, just the very fact, if we revisit this line again anytime soon, because every other time you hit it, it was at least a year apart between signals. So if we hit it anytime soon, then that will probably tell you. And look, if we hit it again, you'll probably know, because we're going to make another run down towards those recent lows. So I just wanted to say that's where we're at. This is what I'm watching, and you can also see these divergences that precede these big drops right here. I've marked the divergent highs right here. You know, we had small divergence there, and it played out for that correction, but we had divergence, divergence, divergence. So there's two ways to use this indicator right there. You can either use it as a buy signal, especially during a bull market. But again, if we are in a bear market like this one, you got your bear market rally out of it, and now it's time to get out. And next time around, I guess this is the takeaway, you probably don't want to step in if we come back to that line once again, especially anytime soon. Okay, this next one up is the NASI, and the NASI is the Nasdaq McClellan Summation Index, ratio adjusted. And this is going to tell you a similar story, completely different indicator, completely different values, but it's telling me the same story. I run this one in this particular chart. I have it going back. I could probably run it longer. This is how I had it saved with these annotations going back to 2004. And again, it is a great buy signal in a bull market. When you get down to this level right there, it's about 950. You can see, or negative 950. You want to step in and buy it. So it looks like that's where, when we hit that level, that's where the market bounces. However, what happens is all bull markets come to an end, right? And so when you get there, all of a sudden you hit this level and you start stair-stepping down, and you can see what happened in a bear market, the last bear market. Remember, the last bear market was from October 2007 to right here, January 09, or I'm sorry, April 09. So might not. Nasdaq bottomed a little earlier, so this is where everything else, including the S&P 500. I'm just had this indicator up, so I'm going to pick on the Nasdaq right now. But this is where April of 09 was where every other index, including the S&P 500, bottomed. So that was your bear market there. And so where I'm going with this is, once you hit that level, normal in a bull market, that contains all pullbacks in the NASI, right? However, in a bear market, things different. You start to see the NASI taking that level out and also making a series of lower lows there. that is showing deterioration in the fundamentals or in the internals of the market. Back in 2018, I refer to this as the shot across the bow. I know it was a year ago, but that's really not that far when you step back and look at the 11-year history of the last bull market. And I think that's, one S&P, well, I know it's when it broke down, it broke my primary trend line, and it's been back testing since. And now, more importantly, you can see the NASI making a series of lower lows, just like back here. So this is, another indicator that points towards more so the fact that this is bear market action here. This is bull market action. This is bear market action. And that was a bear market. And, well, will this be or not? Time will tell. But so far, I've got a pretty good amount of evidence pointing to it. And then finally, here's one more to look at. This is the NAHL. That's the Nasdaq New Highs versus New Lows Index. So very simple. You can see the indicator up here. And what I do is the new high, new low cumulative. I put it on a cumulative setting. And then I run a 20 EMA with it, exponential moving average on top of it. Now, since the lines look so close, you can't make them out. I can zoom in on this chart on my computer if I try to do it in the video. Stock charts is clunky. It doesn't have the quick zoom functionality like TC2000, but there it is. Down below, you're looking at the Nasdaq Composite, and you can see what I've done there is I've given the buy and sell signals in these dotted red or green lines. Like everything, it's not perfect. It does have its whipsaws, but here's what stands out. So what I did is I put it into a histogram form to show you the crossover. So when this histogram crosses the zero line, that's the middle line right here all the way. Oh, there it is. You can see zero line. When it's above, you have the 20 EMA is trading above the NAHL, and works as a great buy and sell signal. I don't have every single one marked. Looks like I started marking them back here. So the red lines are when they crossed, and it was a little whipsaw there given. I left it there just to show you it was a whipsaw, but this was the last bear market. The bear market peaked right here, or the last bull market peaked right there, I should say. This box shows you the entire, not the entire bull, yes, I'm sorry, it encompasses the entire bear market from 2007, October 07 to March 09. But what it does is it shows you the buy and sell signals on this indicator. Did a bang up job of telling you the entire time, or almost all of it, that we were in a bear market. You can see the histograms below, means we had a crossover right there, a bearish cross of 20-month, the 20 EMA below it, and it didn't cross bullish back to here right after the bottom was in. So that's where we're at now. Now, keep in mind, we've been in a bull market since, so you're going to see whipsaws, but it did capture a lot of the corrections. Again, you can pause the video, screenshot this, and I'll also give you a link to it underneath the post here. And there's that big drop back in 2018, the fourth quarter of 2018. Did a pretty good job of triggering early, got you in early. There was your sell signal. So it's a pretty fast indicator and a pretty reliable one. And again, it triggered a sell signal right here. And then what's also what stood out to me is I've been tracking for a long time. I've been watching. I had a trend line back here in the bull market. At this point, I could see that the NAHL had formed a nice clean up trend line and didn't break there. So that was, at least by the trend line, it kept above trend. Right there, when it gave us the bearish crossover, it also broke trend right there. And then I have this great bull market uptrend line right here on the thing, and that just only recently gave us a sell signal. So a couple things happened. We had the crossover between the EMA and the NAHL, and then we also had that trend line break, and you can see it's buried down deep into bearish territory here. In fact, even deeper than we got at any point back in the 2008 bear, and much deeper than any point during the last bull market or the preceding bull market before that. So there it is, guys. Again, these are, unrelated to any price action, anything else. We just looked at 3 breadth indicators followed by or preceded by a handful of trend indicators, and they're all pretty much telling us the same thing right now. Like I said, every bull market and bear market is different. This time around, you have the Fed throwing more money at this situation by far than what they did back in 2008. But I think things are a lot different. I think I can tell you definitively you can make a much stronger bearish case fundamentally with what's going on, what the coronavirus has done, shutting down, not just the U.S. but most, a lot of economies around the world, and still there right now, and that's the thing. So I think the rally right now, I think, is just kind of coinciding with what I said before, that catch-22 situation where, yeah, the number of new cases and the peak projections were going to go down, and sure enough, I'm reading the headlines that the states are at a difference with DC. When to open back up, everyone wants to get back to work. We're gonna, and we'll see that. So as people start to think it's safe to get back in the water, that's when the sharks are going to start swimming again. Meaning that that's probably when you'll start to see a resurgence of cases, and then it'll be another drop in the market, and will most likely coincide with that. I hope that's not the case. Believe me, I would 100 times over take some type of cure or abatement or just whatever it is, have Corona disappear and let the bull market resume. But again, at this point in time, there's just a lot of technical damage done, and because of that and the way these things work, the surge in unemployment claims, everything else, it just takes a while. So right now, again, the gist of this video was to point out that by just about all metrics right now, everything's pointing at this being, or at least fitting the mold of nothing more than a bear market rally. And should we move up substantially from here, more so in percentage terms, as I said earlier today in the previous video, more so in percentage terms than in time. We could trade around these levels for a while, but that's going to keep most of those trend indicators bearish and everything else. And as I showed you before in the previous video earlier today, when we rallied back to the 61.8% retracement in the last bear market rally, and both the minor and major bear market rallies in the last bear market, as well as the one in 2007, that it wasn't a one and done. We stayed there and tested that level, or came back and retested it for several weeks. We may or may not do that. I just wanted to say that that's where we're at. So all right, we'll wrap it up here, and hopefully you guys find this useful. We'll pick it up tomorrow. This has been Randy Finney with Right Side of the Chart. Have a great day.